Welcome to another deep dive. Today, we're cutting through the noise to unpack a really crucial topic. It impacts almost every corner of our economy, but often kind of goes unnoticed. We're talking about the far-reaching ripple effects of current tariff policies on the U.S. commercial real estate sector, CRE.
It's a truly dynamic landscape right now. Trade policies, they aren't just abstract economic ideas floating around. They're actively reshaping, well, everything. How buildings get constructed, where businesses decide to set up shop, even how investment flows. We've pulled together a fantastic stack of sources today that we think will really help you understand these connections and what they mean for the market right now.
Yeah, and what's really striking, I think, is that despite these increased costs, these uncertainties, the CRE market is actually showing some pretty surprising signs of adaptability. I mean, look at this. In the final quarter of 2024, commercial real estate deals actually totaled $108.5 billion. That's a huge jump, 33.6% up from the previous quarter. And get this, an industry survey found 88% of CRE executives are still optimistic about their revenue growth for 2025. Pretty amazing.
Indeed, those numbers really signal that many players in the market aren't just seeing challenges here. They're viewing this volatility almost as a strategic opening, a chance to reposition themselves. So our mission today is really to arm you with the insights you need to navigate this increasingly trade-sensitive environment. We'll be exploring the early impacts across key segments of the market: economic growth, demand, and financing costs. The broader picture.
Okay, let's unpack this then. How did these tariffs, baseline import tariffs at 10%, but some country-specific rates going as high as 145%. How does that fit into the bigger economic picture for the U.S.?
Well, the projections we're seeing indicate they're expected to contribute to a slower pace of economic growth. We're potentially looking at around 1.3% growth for 2025, maybe coupled with mid-3% inflation. And this happens basically because higher costs for imported goods, plus the risk of other countries hitting back with retaliatory tariffs on our exports, well, that can dampen spending, both business spending and consumer spending. Essentially, things get a little pricier, and that tends to slow the whole system down.
Okay, so if I'm just, the everyday consumer, what does that slower growth and higher inflation actually mean for my wallet? What am I feeling?
That's a great question. And there's a Yale Budget Lab analysis that really drills down on this. It suggests tariffs could lead to something like a 1.7% to 2.1% increase in prices for a whole range of goods and services. Now, for the average household, that can mean roughly $2,700 to maybe $3,400 less in disposable income per year. And naturally, when people have less money to spend on, everyday things or going out, it cools demand for commercial spaces. Think retail stores, even offices potentially, as businesses might scale back a bit.
But I remember reading that there's maybe a silver lining in the longer term, right? Something about jobs.
Absolutely. That's the other side of the coin. One potential upside is this forecast for around 400,000 new manufacturing jobs coming back to the U.S. over the next, say, 3 to 5 years. This reshoring, as it's called, bringing production back, well, that can create a real surge in demand for industrial properties, new factories, warehouses, distribution hubs. So it creates this really kind of mixed picture for the overall CRE market. Some sectors squeezed, others maybe booming.
Right. And what about getting these big projects financed? We know higher inflation often makes the Federal Reserve think about raising interest rates. How does that hit borrowing costs for developers?
That's exactly right. Higher interest rates make it significantly more challenging and definitely more expensive to finance those large-scale projects. This is especially true for sectors that need a lot of capital upfront, like industrial and multifamily housing. They rely heavily on big loans. Now, the 10-year Treasury yield, which is kind of a benchmark for long-term borrowing, is expected to stay around 4%. But the Fed might also make some strategic cuts to short-term rates to help the labor market. So you have these mixed signals, right? It just creates a very cautious, kind of complex financing environment overall. 2, the rising tide of construction costs and development timelines.
Okay, here's where it gets really interesting, I think, for anyone thinking about building or investing or even just renting space. How are tariffs directly hitting the actual physical construction of properties?
Well, it's a pretty big deal, frankly, because roughly 1/3 of all construction materials used in the U.S. are imported, and analysts estimate these tariffs are directly causing something like a 3% to 5% rise in overall construction costs. Now, to put that into perspective, materials alone usually make up 50% to 60% of a project's total cost. So, that 3-5% increase, it really adds up fast.
So, yeah, we're talking significant money, not just pocket change. Can you give us some specific examples? What exactly is getting more expensive?
Certainly. If you look back since 2020, overall material costs have jumped about 34%, which is way above the general inflation rate we've seen. For instance, that 25% tariff on steel and aluminum, that's significantly driven up the cost of structural components, the skeleton of the building. And think about lumber. Lumber tariffs alone have added roughly $9,000 to the cost of a typical new construction project, whether it's a house or a commercial building.
Wow, $9,000 just from lumber. Okay, so what are the projections looking like for 2025? Are these costs going to keep climbing?
Unfortunately, yes, that seems to be the consensus. Costs are expected to rise another 4% to 6% in 2025. And some specific materials, things like metals, imported finishes, they could see increases of up to 10%, which obviously raises a huge question for developers and investors. How do you even budget for this? How do you cope with these kinds of escalations?
It's not just the money, right? It's also about time. Delays can be just as damaging, maybe even more so.
Precisely. Exactly. The tariffs are making ongoing supply chain disruptions even worse. We're seeing much longer lead times, delivery delays for critical materials, things like structural steel, specialized glass, even HVAC systems. And this forces developers to constantly reshuffle their construction schedules, resequence things. It pushes out completion dates, which means lost rent, increased holding costs. It's a real headache.
So what does all this mean for the overall supply of new properties and ultimately for rents?
Yeah.
Especially thinking about you, the listener, maybe looking for space as a tenant or future renter.
Well, higher construction costs can actually act like a brake on new supply. If it gets too expensive to build, fewer projects get started. Simple as that. Now, in markets where demand is still strong, this limited supply can definitely push rents higher. We see this particularly in multifamily housing, which could make existing housing shortages even worse. But it's a really delicate balance, because if an economic slowdown also reduces overall demand for space, then occupancy rates and rents in sectors like retail and office could actually face downward pressure. So it cuts both ways.
Okay, so faced with these twin pressures, rising costs, unpredictable delays, how are people in the industry actually adjusting? What strategies are developers and firms using?
They're getting much more proactive, much smarter about it. Developers are doing what's called front-loading procurement. Basically locking in prices for materials way earlier in the project timeline to hedge against those future cost hikes. Commercial real estate firms are also adopting more sophisticated risk mitigation strategies. Things like diversifying their supplier networks, not relying on just one source from one country, embracing more flexible sourcing models, and crucially, building in larger time and financial buffers, contingencies, right into their project planning from day one. Expecting the unexpected, essentially. 3, sector-specific impacts and adaptations.
Okay, let's zoom in a bit now. How are different parts of the CRE market reacting? Let's start with industrial and warehouse spaces. They seem pretty central in this whole tariff and supply chain discussion.
Yeah, and what's truly fascinating here is just how resilient the U.S. industrial and warehouse sector has been. It's remarkable. Despite all these headwinds we've talked about, market reports show really robust leasing activity in the first quarter of 2025. We're talking 123.3 million square feet leased. That's actually the strongest performance we've seen since the second quarter of 2024. So demand is still very strong there.
That is impressive, given everything else.
Yeah.
Are any specific types of facilities standing out in this growth?
Yes, absolutely. Mid-sized facilities seem to be the sweet spot, those between, say, 100,000 and 250,000 square feet. They accounted for about 27%, almost a third of the total leasing volume. And that really highlights a strategic shift, towards more flexible, more scalable logistics solutions. Companies want options. And of course, e-commerce is still a huge driver. Online sales hit nearly $1.2 trillion in 2024. That's up 8.1% year over year. That just underscores the relentless need for quick fulfillment and storage.
And are the tariffs themselves actually pushing international companies to change their game plan here in the U.S., like forcing them to maybe build up more inventory stateside?
They absolutely are, yes. In direct response to these new tariff policies, we're seeing some international firms, particularly some big Chinese e-commerce and logistics players, actively expanding their U.S. warehouse footprints. They're basically trying to build a buffer, right, to mitigate risks from potential shipping delays out of Asia and those added import costs. Now, the national industrial vacancy rate did tick up slightly, but the expectation is it'll stabilize in the second half of the year as these adjustments sort of play out.
Okay, let's shift gears to retail. Retail usually feels the pinch pretty quickly when consumer spending slows down. How are tariffs hitting the shops and businesses we visit every day?
Yeah, the commercial retail property sector is definitely feeling those effects, especially from tariffs on Chinese imports, those cost increases. They're directly pushing major retailers, think Walmart, Target, to raise prices on a whole bunch of everyday goods. And that inflationary pressure, well, it's visibly cooling consumer demand. We saw retail sales growth slow dramatically, down to just 0.1% in April 2025. That's a steep drop from 1.7% just the month before in March.
Wow, 0.1%. So with consumers clearly pulling back, what are retailers and their landlords doing to adapt?
Well, many retailers are getting much more conservative in their strategies. They're slowing down expansion plans, particularly for stores selling non-essential items. They're also carefully reevaluating their existing real estate footprints, maybe closing underperforming stores or consolidating. Landlords are having to respond. They're offering shorter lease terms, providing bigger tenant improvement allowances. That's money to help tenants build out their space. And they're creating more flexible co-tenancy agreements. Those are clauses that might lower rent if, say, a major anchor store leaves the shopping center. Investors, meanwhile, are really prioritizing what they see as necessity-driven retail. Think grocery-anchored centers, urgent care clinics, vet services, things people need regardless of the economy. Those tend to be more resilient.
Right, the needs versus the wants. Okay, and what about the office market, especially for those big multinational corporations, the ones with complex global supply chains tangled up in all this?
Yeah, the U.S. office market is definitely undergoing some significant shifts right now. Multinational corporations are absolutely reevaluating their office space needs in direct response to these tariff policies. Rising operational costs, supply chain uncertainties, it's prompting many global firms to consolidate the space they already have and definitely hit pause on making new long-term leasing commitments.
What are the numbers telling us about this shift? Is vacancy really going up?
Oh, yeah. As of March 2025, the national office vacancy rate climbed to 19.9%.
Wow, almost 20%.
Exactly. Nearly 1/5 of all office space sitting empty. And that reflects about a 1.7 percentage point increase just year over year. It's been particularly sharp in major coastal markets, the ones really exposed to international trade, New York, San Francisco, Chicago. The first quarter of 2025 actually saw what we call negative net absorption in several of those big cities, meaning more space became vacant than was filled. That signals a clear pullback from companies with big global footprints.
So we hear a lot about reshoring companies bringing operations back to the U.S. Is that making any difference here, or is it maybe creating new demand for office space that balances things out?
It is making some impact, but it's still really an emerging trend. Reshoring, bringing back manufacturing, R&D, maybe some corporate functions. It is an evolving response to these global trade issues. And while, yes, it could eventually create some specialized demand for new office or maybe flex workspaces, particularly in secondary markets, the immediate effect we're still seeing is actually a contraction in traditional office demand. So that suggests these vacancy challenges, especially in the big urban centers, are likely to stick around for a while yet. 4, tariffs' influence on foreign investment choices.
So all these trade uncertainties, the tariffs specifically, how are they influencing who invests in U.S. commercial properties from abroad? Are we seeing foreign money getting nervous and pulling back?
It's having a really significant and quite visible effect, actually. As of early 2025, Chinese investment in particular has dropped off markedly. I mean, look at the numbers. Chinese investors sold off roughly $31.7 billion worth of U.S. commercial real estate between 2019 and 2023.
Billion. Wow.
Yeah, billion. And that's about 15 times more than they actually acquired during that same period. Now, that's largely down to the ongoing trade tensions, sure, but also tighter capital controls back in China. But it's not just China. Overall, international capital transaction volume hit $52.6 billion over the past 12 months, and that reflects nearly a 40% drop year over year.
Yeah,
so a definite cooling.
Okay, that sounds like a pretty dramatic pullback across the board. But
yeah.
Is there any light at the end of the tunnel? Are projections showing any kind of bounce back for foreign investment?
Well, this is where it gets kind of interesting, almost paradoxical. Despite those significant headwinds we just talked about, forecasts are actually projecting an encouraging 39% annual increase in foreign investment for 2025.
Really? A 39% increase after that drop?
Exactly. It signals a renewed confidence, maybe, but definitely a more cautious confidence in the U.S. market. What we're seeing is investors adopting a much more strategic, much more selective approach. They're prioritizing assets that feel safer, properties with long-term leases already in place, tenants with strong credit ratings, things offering greater income stability in this uncertain environment.
So what types of properties or maybe what locations are getting the attention from these more selective foreign investors now? Are they still focused on the big gateway cities or looking elsewhere?
We're seeing a growing emphasis on more specialized asset classes, things like logistics centers, obviously tied into those supply chain shifts. We discussed data centers, life sciences facilities, sectors with unique growth drivers. And we're also seeing a clear shift away from just the primary urban hubs towards secondary and even tertiary markets. It's all part of a broader diversification strategy, spreading the risk. So the takeaway is foreign capital is expected to keep playing a steady role, but definitely a much more selective targeted role going forward. The impact on renewable energy and green building projects.
Okay, let's talk about green buildings. There's been such a huge push for more sustainable construction. How are tariffs affecting that trend? It feels like these projects using new tech and materials might be particularly vulnerable to import costs.
You're absolutely right to ask that. This sector is really experiencing both significant challenges and some interesting opportunities right now. On the one hand, you've got strong federal incentives, tax credits, especially from the Inflation Reduction Act. Those continue to really bolster the transition to sustainable construction, making it financially appealing. But on the other hand, yes, rising costs on imported materials crucial for green building, things like solar panels, specialized steel, innovative energy-efficient technologies. Those are straining project budgets and timelines. It's compressing profit margins for developers and definitely contributing to delays. So yes, it often becomes more expensive, initially at least, to build green because of these tariffs.
So it's kind of a push-me-pull-you situation then. Incentives encouraging green building, but tariffs making the materials pricier. What's the long-term outlook? Is green still winning out?
Precisely. It's a real tension. But despite those tariff-induced cost pressures, the sector's long-term outlook remains remarkably strong. It's quite striking. Consider this. The global green building materials market was valued at around $287 billion recently. It's actually projected to more than double, reaching almost $700 billion. $693.5 billion by 2034. That signals really sustained confidence and, frankly, a powerful underlying momentum that tariffs haven't derailed.
And is the demand still there from tenants and investors for these kinds of environmentally responsible properties, even if they cost a bit more upfront?
Oh, absolutely. What's truly fascinating here is that the demand just keeps growing. It's being driven by multiple forces all at once. You've got investor mandates focusing on ESG, environmental, social governance criteria. You've got corporations setting their own sustainability goals, and you just have shifting expectations from tenants themselves. People want to be in greener buildings. So developers and property owners are responding smartly. They're adopting innovative strategies, using more locally sourced or recycled materials, integrating the latest energy-efficient tech, pursuing certifications like LEED or WELL, because these things demonstrably boost asset value and market appeal. It proves that even with tariff headaches, sustainability is still a key differentiator, a valuable one. 6, investment strategies, capital markets, and leasing trends.
Okay, let's try and bring all these threads together now. How are these tariff-driven changes fundamentally reshaping overall investment strategies and the capital markets and commercial real estate? What's the big picture for investors?
Well, the implementation of these tariffs has definitely triggered significant shifts across the board for investors, no doubt about it. The rising costs we've discussed for imported construction materials, for foreign equipment, they've really pushed investors to adopt a much more selective, much more strategic approach than maybe a few years ago. There's a very noticeable and growing preference now for asset classes that offer stable, predictable cash flows, ones that are somewhat resistant to inflation. Think logistics centers, which are just essential for how goods move, and data facilities, powering our digital lives. Those look pretty attractive right now.
And what about how these big deals actually get financed? Are we seeing changes in where the money comes from, who's lending?
We are, yes. Investors are definitely diversifying their portfolios, more spreading bets across different property types, different geographic regions, specifically to manage these tariff-related risks. They're also restructuring their capital stacks. That's just the mix of money used to fund a project, traditional bank loans, maybe private equity, other sources. And because traditional bank lending has tightened up a bit amid all the economic uncertainty, we're seeing alternative financing sources step in more, things like private equity funds, mezzanine capital, that's a kind of hybrid debt equity financing. Lenders who are active remain pretty cautious, though. They're enforcing much stricter underwriting standards. It's just harder to get a loan for anything perceived as risky. So ultimately, what tariffs are doing is accelerating this broader shift towards really selective capital deployment. Money is flowing, but it's flowing towards assets seen as resilient to these macroeconomic bumps.
Right. Okay, and turning to you, the listener, maybe you're a tentative small business owner, maybe part of a larger corporation. How are these tariff policies impacting your leasing decisions? And what are landlords offering now in response?
Yeah, for tenants, especially in sectors like logistics and retail that are directly hit by import costs, it's forcing a reassessment of strategy. They're looking hard at how to manage their operating expenses better. This often translates into maybe downsizing their physical space, definitely negotiating for more flexible lease terms, shorter commitments, more options, and really emphasizing cost-sharing mechanisms like asking for bigger tenant improvement allowances, where the landlord helps cover the cost of fitting out the space to their needs.
Are there specific types of spaces or maybe regions where leasing demand is actually holding up or even strong right now?
Absolutely, we are seeing that. Recent market data shows increasing demand for those mid-sized industrial spaces we mentioned earlier, and also for flexible office or flex spaces, particularly in regions like the Midwest and the Southeast. That seems to be where a lot of this reshoring and supply chain localization activity is happening, driving demand. In the retail sector, though, it's a different story. That tariff-induced price inflation, it has clearly weakened consumer demand overall. So we're seeing retail tenants hitting pause on expansion, trying to renegotiate leases based on their actual sales performance, and really pushing for more favorable rent structures from their landlords.
And despite all these cost pressures, does that push for sustainability we talked about still matter to tenants? Are they still asking for green features?
Absolutely. It remains a really critical factor, maybe even more so in some ways. Tenants increasingly value buildings with sustainable features, good energy efficiency, integrated tech. Why? Because it directly lowers their utility costs over the long term. And it also helps them align with their own corporate ESG, environmental, social governance objectives, which are becoming more important for attracting talent and investors. And the proof is in the pudding. We're consistently seeing that green certified buildings can often command premium rents and achieve stronger tenant retention rates. They're just more desirable spaces. Landlords are definitely responding to this. They're offering more generous concessions sometimes, upgrading property infrastructure to be more efficient, introducing tech-enabled services that make the tenants' life easier. All these shifts really mark a broader transition toward more flexible, more value-oriented leasing models across the board in commercial real estate. Outro.
So wrapping this up, what does this all mean for you, our listener, as you try to navigate this really rapidly evolving landscape? We've covered a lot of ground today, from increased construction costs to shifting investment patterns and these incredibly adaptable leasing strategies.
Yeah, and if we try to connect this back to the bigger picture, I think what we've really seen today is the commercial real estate sector demonstrating some remarkable agility. It's pretty impressive. It's not just sort of passively reacting to tariffs. It seems to be actively adjusting, strategizing, and in some cases, even creating new opportunities in response to these external pressures.
That really was a deep dive. And it leaves us with, I think, a pretty provocative thought for you to mull over as we finish. Given this widespread adaptability we've seen from the U.S. commercial real estate sector, in the face of all this tariff volatility, from strategic deal repositioning to innovative leasing, even that projected increase in foreign investment, what does this suggest about the fundamental resilience of the wider U.S. economy when it's faced with significant external pressures like these?
Are these adaptations we've discussed just clever coping mechanisms for the short term? Or are they maybe, just maybe, laying the groundwork for more robust, perhaps even more localized economic structures in the long run, especially when you factor in those strong growth forecasts for things like green building and the industrial sector? Definitely something to think about.
Yeah.
Get in touch with Allies Commercial Realty at info@alliescommercialrealty.com to find your ally in commercial real estate.